Hey everyone, and welcome back to Simple Mindspace. Today we're diving deep into the world of ETFs, exchange-traded funds. Whether you're just starting your investment journey with $100 or looking to diversify your portfolio, this episode is your step-by-step guide to understanding and building wealth with ETFs. Now you might be thinking, ETFs? Sounds complicated. But trust me, they're anything but. Think of an ETF as a curated basket of stocks. Instead of putting all your eggs in one basket by buying a single company's stock, you're spreading your investment across a variety of assets, all neatly packaged in one ETF. Let's break down exactly what makes ETFs so special. They're like the superheroes of the investment world, offering several advantages. Low expense ratios. Imagine paying someone a tiny fraction to manage your investments. That's what expense ratios are, and ETFs are famous for having some of the lowest out there. We're talking as low as 0.03% per year. That's like paying just 30 cents on a $1,000 investment. Diversification is key. Remember those baskets we talked about? That's diversification in action. By investing in an ETF that tracks, say, the tech sector, you're automatically invested in multiple tech companies. It's like having a safety net for your investments. Tax efficiency. ETFs are designed with your tax benefits in mind. Holding them long-term for over a year can lead to lower tax rates on your gains. Who doesn't love keeping more of their hard-earned money? Trading ease. ETFs trade on stock exchanges just like individual stocks. This means you can buy and sell them easily throughout the trading day, giving you greater flexibility and control over your investments. Now you're probably wondering, what's the difference between an ETF and an index fund? It's a great question, and the answer is pretty straightforward. ETFs and index funds share many similarities, but the key difference lies in their trading mechanisms and associated costs. Think of ETFs as the more agile sibling. They can be traded throughout the day, much like individual stocks, making them highly liquid. When you sell ETF shares, your capital gains or losses are directly reflected in your account. Index funds, on the other hand, are like the steady and reliable sibling. They are bought and sold once a day at the end of the trading day. This means that the price you buy or sell at is determined by the net asset value, NAV, calculated at the end of the day. While both offer diversification and the potential for long-term growth, ETFs often have lower expense ratios and greater tax efficiency compared to index funds. This makes ETFs a particularly attractive option for beginner investors. However, remember that both ETFs and index funds play valuable roles in portfolio diversification. Consult with a financial advisor to determine which investment vehicle best aligns with your individual financial goals and risk tolerance. Now that we've demystified ETFs, let's look at the two main flavors they come in. Passive ETFs. These are the laid-back ones. They aim to mirror the performance of a specific market index, like the S&P 500. Imagine effortlessly tracking the performance of 500 of the largest U.S. companies just by holding one ETF. That's the power of passive ETFs. Active ETFs. These are for the more hands-on investor. Active ETFs have portfolio managers who actively pick and choose the stocks within the ETF, aiming to outperform the market. While potentially more rewarding, they usually come with higher expense ratios due to the active management involved. Now, before you jump into the exciting world of ETF investing, here are a few essential factors to consider. Expense ratio. This is like the participation fee for owning an ETF. As we discussed, lower is always better. Aim for ETFs with expense ratios below 1%, and ideally even lower, to maximize your returns over time. Assets under management. This refers to the total market value of all the assets held within an ETF. A higher AUM often indicates greater liquidity and investor confidence in the fund. Investment niche. Consider what you want your ETF to track. Do you want exposure to the broad U.S. stock market, emerging markets, or perhaps specific sectors like technology or healthcare? Choosing an ETF aligned with your investment goals is crucial. To make your decision easier, let's explore some of the most popular ETFs favored by seasoned and beginner investors alike. TESPI, SPDR S&P 500 ETF. This ETF tracks the S&P 500, a benchmark index of the U.S. stock market. It boasts a low expense ratio, making it a cost-effective way to participate in the growth of large-cap U.S. companies. VTI, Vanguard Total Stock Market Index Fund ETF. For investors seeking even broader market exposure, VTI is an excellent option. It tracks the entire U.S. stock market, including small, mid, and large-cap companies. Vanguard S&P 500 ETF. Similar to SPY, VO offers exposure to the S&P 500 with a razor-thin expense ratio, making it a favorite among cost-conscious investors. Remember, investing in ETFs isn't just about buying and forgetting. While they offer a degree of diversification, it's crucial to diversify your portfolio further. Don't put all your money into a single asset, no matter how promising it seems. Consider investing in yourself and your skills. This could mean taking courses, attending workshops, or even starting your own business. The returns on investing in yourself, both personally and professionally, can often far outweigh the returns from traditional investments. Before diving into any investment, remember to do your research. Take the time to understand the ETF, its holdings, its historical performance, and its associated risks. There are plenty of resources available online and through your brokerage platform to help you make informed decisions. Once you've chosen your ETF, it's time to start investing. The beauty of ETFs is that you don't need a fortune to get started. Many brokerage platforms allow you to invest with as little as $100, or even less through fractional shares. One strategy I highly recommend, especially for beginners, is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. Think of it as a disciplined approach to investing that takes the emotion out of your decisions. By investing consistently over time, you're essentially buying more shares when the price is low and fewer shares when the price is high, averaging out your cost over time. Remember, investing is a marathon, not a sprint. Don't get discouraged by short-term market fluctuations or feel pressured to time the market perfectly. Stay focused on your long-term financial goals, be patient, and stay consistent with your investments. As we wrap up today's episode, I want to leave you with one final thought. The most significant investment you can make is in yourself. Continuously strive to acquire new knowledge, develop valuable skills, and expand your horizons. Remember, your ability to earn, grow, and build wealth ultimately stems from your knowledge, skills, and experience. So never stop learning, growing, and investing in your most valuable asset, yourself. That's it for today's episode. If you enjoyed it and found it valuable, please give it a thumbs up and subscribe to my channel for more empowering content on investing, personal finance, and entrepreneurship. I appreciate your support. Until next time, happy investing, and remember to always invest wisely. Peace.